Well, hello everyone, and thank you for joining us. I have 10:01, so in an effort to keep everybody's calendars moving forward and all the things you got going on today moving forward, I think we'll try to get started here kind of on time. I'm Heather Gessner, the Livestock Business Management Field Specialist from SDSU Extension, and we greatly welcome you to today's session. This is our 12th event, so I appreciate everyone's continued involvement in this monthly activity. With that kind of in mind, I'm going to ask just one question as some people kind of are still clicking on. It's a new tool here for me. So if you could answer this polling question for me. We've had 12 of these ag economic dialogues, and if you could just let us know if this is the first one you've ever joined or if you've been to all 12 of them. We'd like to know that too. So we'll give you a couple seconds here to click in on this poll, if you would, please. I think if we think back to the very first one, we did a joint venture, so you could either join us online or in person. And now with the COVID situation, it was pretty easy to make that transition to just 100% online for these ag economic dialogues. So I think we'll end the polling. Thank you to those of you that participated. It's great to see you. And we'll kind of run with it from there. So to kick off today, we have three presenters that are going to join us. Danita Gary is here with the FSA office and is going to provide some information on the WIP Plus program. Jack Davis is going to cover the crop side of the situation, a little crop progress and some cash flows. And Matt Dearson is going to back cleanup for us today and cover the beef markets and some of what's happening in the beef market side of things today. So a little housekeeping quick. If you do have questions, we would ask you to type those into the chat box. And at the end of the presentations, we will get your questions answered there as we go through each of the different presenters. So with that, I think, Danita, if you wanted to unmute your microphone and share your presentation, we will get started.
Okay, thank you, Heather. Are you able to see my screen? And
yes, we have your screen and your video, so it looks like we're good to go.
Okay, great. Well, good morning, everyone. I'm Danita Gary. I'm a program specialist at the Farm Service Agency State Office in Huron. The Farm Service Agency, of course, offers many programs available to producers. And we're certainly hoping that we have a better 2020 spring and summer for planting and growing crops. But what I'm going to cover today is the WIP Plus program, which is intended to provide assistance to producers who suffered crop losses due to certain weather events in crop years calendar years 2018 and 2019. So what does WIP Plus stand for? Well, it stands for Wildfires, Hurricanes, and Indemnity Program, and that was a 2017 program. And then with all the flooding and things in the Midwest, they added the plus to the end. So, and that is where we get WIP Plus, the reference to WIP Plus for calendar years 2018 and 2019. So WIP Plus was authorized under the Additional Supplemental Appropriations for Disaster Relief Act of 2019, and it provides assistance for crops, trees, bushes, and vine losses due to the floods, snowstorms, wildfires, tornadoes, typhoons, volcanic activity, and hurricanes occurring in 2018 and 2019 calendar years. So the federal regs for this, the WIP Plus program, were published September 13th of 2019, and it includes crop losses for production losses, and for value loss crops, it would include inventory losses. And for tree, bush, and vine producers, it covers the losses for the loss of the tree, bush, or vine. And so basically the eligible disaster events for producers in South Dakota would be the floods, snowstorms, or tornadoes. And keeping in mind the WIP Plus pays for losses occurring during the calendar years 2018 and 2019. So even though a disaster event occurred in calendar year 2019, it could affect 2020 crop year crop as well. So then the further Consolidated Appropriations Act of 2020 was signed December 20th, 2019, and that provided new legislation. So it added excessive moisture and drought of G3 or greater for the year. So those are additional qualifying disaster events that were added to WIP Plus, and county offices could begin taking applications for those qualifying events starting March 23rd of 2020. So it does list a drought of D3 or greater. So just a note, there are only about 6 counties in South Dakota for crop calendar year 2018 that would be eligible due to the qualifying disaster event of drought. Also, the Act added quality loss as a qualifying event as well. And they're still working on the policy for being developed for the quality loss. So at this time, county offices are not able to take applications due to quality loss. But however, if you did have a production loss, certainly stop or visit your FSA office and make application. Also, I'm not sure if we have many sugar beet producers in South Dakota, probably in North Dakota more prevalently, but the Act also includes 2018 and 2019 sugar beet losses to be paid by the cooperative processors. So to be eligible, you had to be in a county, a primary county having a presidential declaration or secretarial disaster designation for the qualifying disaster events that I listed previously. You can find that on the website that I've listed here. On the fsa.usda.gov website will list the eligible states and counties. However, if a county does not have a primary presidential declaration or secretarial designation for a qualifying disaster event, the producer may still be eligible, providing they provide documentation to the county committee showing the crop production loss was due to a qualifying disaster event. However, the exception is drought. For drought, you must have been in a county with a D3 or greater in the year. So so producers in any primary declared counties, they just need to certify that their production losses were due to a qualifying disaster event. However, for producers that are not in a primary declared county, it just takes a little extra step that the producers and the county offices need to document that the production loss was due to one of those qualifying events. The payment limitation for this program is $125,000 per person or legal entity. However, there is a optional payment limitation of up to $250 per program year if at least 75% of your income is derived from farming, ranching, or forestry. So overall, it would be a $500,000 payment limitation for those years. Also, just a note, WIP plus payments and the payment limitation will be subject to a 50% factor for the years 2019 and 20. So for 2019 and 20, what your WIP plus calculation calculates to be at this time, we'll only authorized to pay 50% of that calculation. However, this factor may be adjusted following the WIP plus enrollment period, providing adequate funding is available to fund the rest of the applications. So it's just for 19 and 20, you'll only receive 50% of the calculated payment at this time. The other provisions that are applicable to WIP plus, the AGI, the adjusted gross income provisions, do not apply for this program. However, the conservation compliance provisions do apply. So you will need to sign an 80-1026 form with, or have one on file in the Farm Service Agency office. Also, when making application, we also have the form FSA 895 for a crop insurance and or NAP coverage linkage requirement. So as a condition for receiving WIP plus benefits, then producers will need to obtain crop insurance or NAP on the crop for which they received WIP plus benefits for the first two available consecutive crop years after the enrollment period ends for WIP plus. And you need to meet that linkage requirement no later than the 2023 crop year. And also, it is a requirement that it needs to be at a coverage level of 60, 100, or equivalent. So the eligible crops, you can make application for the insured crops through crop insurance. Also, NAP coverage crops are eligible, and also uninsured crops. So the eligible crops had to have been planted or prevented from being planted with the intent of harvest, and the intended use of grazing is not eligible for WIP plus. Prevented planting, that you're eligible for 2018 and to 2020 crop year prevented planting acres, and to 2019 crop year uninsured and NAP covered acres. However, for crop year 2019, the insured crops are not eligible for WIP plus. The federal crop insurance provided prevented planting supplemental disaster payments applicable to the 2019 crop year prevented planting crops as determined by the risk management agency. And those additional payments from RMA were referred to as top-up payments. And so that is the reasoning why the insured 2019 prevented planting crops are not eligible for WIP plus. So an eligible producer needs to be a US citizen, a resident alien, a partnership, corporation, limited liability company. Also landowners, landlords, tenants, contract growers, or anyone else not having both a share of the risk and a valid claim of share ownership of a crop are not eligible. So basically the landowners, landlords, tenants must have been reported as having a share on the FSA 578. So how is the WIP plus payment calculated? I have a screen here. It's the expected value, which is basically acres times price times yield times a guaranteed adjustment factor, which would be, for example, late planting factor, times a WIP plus factor, which I'll show you on the next slide. And that will equal the WIP plus value. And then we subtract off the actual value. So basically that's the producer's production times price. And then we'll subtract any indemnity like from crop insurance or NAP crops. And also subtract any secondary use or salvage value. So that's the basic calculation for the WIP plus. The WIP plus factors, as you can see, the WIP plus factors increase based on the higher the coverage level of the insurance or NAP covered producers. So uninsured producers have a WIP plus factor of 70% in their calculation. Producers that have CAT level coverage or NAP basic 50-55 will have a 75% WIP plus factor. And for insured producers, the WIP plus factor increases by the producer's coverage level. So reporting production, to be able to calculate the actual value, then we need the producer's production. So for insured crops, more than likely we'll have that available to us through RMA. We do receive RMA downloads of production, of loss records, indemnity amounts, and other production. And for NAP covered crops, we should have that available in the FSA office if the producer reported their NAP production or NAP losses. However, for uninsured crops, the producer will need to provide verifiable or reliable production records. So just keeping in mind, more than likely for those insured producers, we will have quite a bit of the RMA data needed, such as the production. However, if you do have an insured policy that does not require production to be reported to RMA, then the producer will be required to provide acceptable production records to FSA. So the WIP plus sign-up period, the participants will file the WIP plus application form, FSA 894, in the administrative county office responsible for the farm records. So for multi-county producers, if you go to, if you have farms administered out of 2 different offices, 3 different offices, you'll need to make contact with those offices so they can start your WIP plus application in those offices. Also, all signatures must be received by the sign-up deadline. However, no deadline has been announced at this time for WIP plus, as they're still working on the quality loss policy and that. So we don't have any idea when a deadline will be announced, but it will be well, watch your newsletters, the FSA office, things like that. But also, there's no late filed provisions. So once the deadline has been announced. So what is the next step for producers? First, contact your local FSA office. They are open for business by phone appointment, so make that contact with them to request to file an application. Producers may need to provide additional evidence the production loss was due to a qualifying disaster event. So just keep that in mind. Also, we may need additional production evidence. However, for those insured crops, we should have quite a bit of that data. And there may be other information the office needs to complete the WIP plus application. So additional information, of course, can be found at your local FSA office, and also the websites, fsa.usda.gov and thefarmers.gov. That's just a high-level overview of the WIP plus program. As you all know, there's been an announcement for a CFAP program We don't have a lot of information on that program at this time. We are having training. The FSA offices are having training next week on that. However, for those producers that maybe have not visited our FSA office, you may want to make that initial contact with them and just start the process of getting you in our system, maybe any other forms that you can sign for eligibility purposes. So that additional information will be coming on that program as well. And that's all I have for right now. If there is any questions, I can certainly answer those at the end or.
Yes, so Danita, we had one question come in wondering about your statement that said additional evidence for a qualifying weather event. Can you give us an idea of what that entails, what that would be?
Yes, we have supplied the county offices with a number of different websites they can go to. Like, for example, if the disaster event, the production loss was due to excessive moisture, there's mapping available that shows the percentage of normal moisture. However, the producer, if they have crop insurance records or a statement from the loss adjuster notes that says their loss was due to excessive moisture, that would be acceptable. Just a little extra step in documenting for those producers that are not in a primary county. Just so between any evidence the producer would have, along with you know, the county office, what they have to document the qualifying disaster event, and the county committee would just need to determine that documentation was acceptable.
Are there any other questions on the WIP Plus program for Danita?
There is one more there, Heather. Do you want me to just read it?
Yeah, if you would, please.
Yeah. It's asking, is it true that the WIP Plus requires harvesting to establish actual value? And two-part question, what if the crop was not able to be harvested due to flood?
Okay, so for those acres that were harvested, we do need production evidence. However, if production evidence is not available, the producer can certify to the production they received on the harvested acres. However, the county will need to establish what's called a county disaster yield. And basically that's an average yield that producers had throughout the county. And so we set a disaster yield that will need to be put up against the producer's certified production. And then for those harvested acres, we'll take the higher of, in the calculation, the higher of the producer certified production, or the county disaster yield will be assigned. So for those crops that maybe were not able to be harvested, such as maybe some hay ground that was flooded due to excess moisture, that is handled the same way. We need to have the county committee establish a county disaster yield, and that yield will be assigned to those acres in the calculation. And then within that calculation for the unharvested part of the acres, an unharvested factor will also need to be applied to in the calculation to account for those expenses that weren't incurred because they weren't harvested. So I hope that answers your question. Basically, the counties will need to establish a county disaster yield, an average yield, and that needs to be approved at the state committee level as well.
Thank you, Danita.
Yes, you're welcome.
Anything else quick before we move on? Okay, seeing none, I believe, Jack, we will have you pull up your screen and we'll go on there. I think Danita's going to stick with us through the rest of the presentations. So if you do come up with a question, feel free to type it in and we'll make sure that we get that asked as we go forward. So with that, Jack, the floor is yours.
Okay, we'll get started here. Going to go through planting progress, a quick look at WASD and tied in with some cash flow things that we can hope for as we go through this year. And let me see here if I can get this to work. Oh, it doesn't want to work right now. Anyway, one other thing I got coming is later today we have with the agronomy group, they do Farming Friday. So it's just some agronomic issues and economic issues that come about as the season goes. And that's the website that's available on, or you can search the Facebook for Farming Friday SDSU extension. One of the things that we're going to do this year is we're going to follow some fields with wheat, corn, oats, and some soybeans. So partake in that, and if you got questions that arise from any of that, be sure and get them out to the people that are involved with that. So we'll look at our corn planting progress. We've got a few different charts here, and if I get my pointer to work right, we'll raise in. I don't want to, there we go. Okay, so 19 started on our bottom with this blue line, was our slowest in a long time. And and I'm sorry, let me back up. This jumped around on me. Sorry about that, guys. So back here, I'm back to corn, and I want to get to national, go back one more. There we are. So week 14, that's like the first week of April. 18 would be first week in May, and 23rd, we're getting towards our end of the final plant time frame for corn. So 2019, you all know, really got drug out. 2020, very good planting so far nationally. We're right at 5-year average, and out here was 2010 when it was really fast. It doesn't necessarily translate to higher yield, but boy, you have to have it in the ground to get a yield. So good progress being made. I think farmers are feeling good about being able to get work done and actually get stuff growing. At least they have some potential anyway. So looking at South Dakota's progress, South Dakota really got drug out. We were almost to final plant time frame, and we were less than 50% planted in South Dakota. And as you guys know, it was tough all year, tough through harvest. It just continued. So really well ahead starting out. Now we're right about even with the 5-year average, and this would have been came out Monday, so it's really as of last Sunday. I think for most of South Dakota, it's probably been a pretty good week this week, and I would not be surprised to see that jump to 75–80% done on corn, and maybe even more. Where guys can go, they're going pretty hard, and it does not take them long. So looking at soybeans, and also a question came in on our last one, if I was seeing a switch in corn to soybeans. So I had the chance from our last one to talk with some suppliers throughout South Dakota, and what I picked up from them, is no scientific research, just visiting, is that they're seeing about a 10% shift of what guys had planned out of corn. And most of that probably into soybeans, some into some small grains. So from their initial attentions, what they started out last fall or January, they have switched about 10% out of corn. So that's kind of interesting. We'll see how that'll play out throughout the year. So again, 19, very, very slow. 20 is right close and probably will surpass 2010 as the fastest in the last 10 years. So I know guys are going hard on soybeans in many areas already. And of course, South Dakota, oops, sorry, oh. Too many buttons I'm trying to play with here, Heather. We'll get you, if you don't get dizzy, I'll get you back on track. So here's our South Dakota, and we are ahead of the 2010. So well ahead of it, ahead of 5-year average on soybeans. And I know of quite a few producers ground where they want to go with soybeans was in better condition. So I know many were planting beans maybe ahead of corn and waiting on the corn a little bit too. So taking a quick look at our WSDA, of course, this would be their first look at the new crop that we're putting in right now. And yeah, you know, so planting intentions are forecasted up quite a bit from what we were last year. We'll see how that'll play out. So that, of course, gives us, you know, another 8 million acres to be harvested, and this trend line yield. So these early reports, you know, really pretty positive for production, not so much for price. And that's how it is every year. We still got a long growing season ahead of us, and there'll be challenges that'll come up and things that will not probably happen. You know, one of the things doesn't probably take into account is some of the prevent plant that will occur. Of course, we don't know what that's going to be, but there will probably be some. You know, South Dakota's still got some very wet spots. We also, North Dakota, probably some very wet areas, and we'll just have to see as the year goes along. So with that many more acres, it's quite an increase in production over last year. So leaving us a very healthy total supply of corn going forward. They have raised the feed usage by 350 million bushel, which is a good deal, and showing that more of the crop is going to probably be used as we go forward. And they must be assuming that ethanol gets a little bit more back on track. It's not quite probably what it was a couple of years ago, but throughout the year, anticipating probably that travel resumes to somewhat normal later on in the year, and that fuel prices probably rebound and ethanol continues to be good. The anticipation of pretty decent export market also here, but still leaving us with stocks to use of 22%. That is the largest it's been since 87, 88 crop year. So as you can see, our national average price, or average marketing year price, right at 320. So down about 40 cents for the marketing year of 2021. Yeah, so it's just, you know, if something wasn't done with, and that can be hard to do coming off of last year, and this hit, the COVID stuff hit pretty quick, and just, yeah, it's going to be kind of a challenge as guys work through this and maybe wait for some opportunities to get some price. Don't anticipate big rises, you know, probably going to have to take, maybe if we get in that 350, 360, 70 area, time to start getting some sold if they don't have any completed yet. Just some keys looking through to what will help get guys through, especially on the corn side, and of course it works for all farm area. But cost of production, boy, it's really key. And I just pulled some stuff from 2019 cost of production. And where I've taken this is from Finbin, University of Minnesota, and I pulled or queried North Dakota, South Dakota, Minnesota, and Nebraska. And that's about 3,000 farms total in that group, but I narrowed that down to 1,000 to 2,000 acre crop farms that are cash rented corn. And in our top 40% of net income, they had a $90 an acre net above the next level down, the next 20%, the 40 to 60% net income range. So really key in cost of production. Crop insurance also can possibly help out. You know, if you run up into a disaster, many of those, as I was looking through it this week, was 60 some dollars an acre in crop insurance across the board in both sets there. Farm program choice, PLC, price loss coverage is PLC, will, if we're set on that 320 price level, that could pay real well, but that's a long ways out. That's not going to come till October of 21. And we'll also look going forward here is the carry charges that have developed since COVID started. So looking at December corn to July corn, 21 corn. Also a good strong relationship with banking to help them through this shortfall in cash flow. And also key along with that cost of production is ability to manage that price risk. That's a tough one. And the guys that have got that figured out for their operations will work through this just fine. So just looking at the different price or cash flow situation things that are out there, or items that may have influence on that. Loan rate is at 220. So if guys want to use that FSA loan, or they can get that 220 a bushel to hold it and set them over until maybe a better price arises. This was December futures yesterday for corn at 331. Our reference price for the price loss coverage is at 370. The spring crop projected insurance price was 388. And I used some averages from Moody County. So these are just estimates using a price loss coverage yield of 160, kind of a trend yield of 200, a little over 200. So using this and a 320 market year average price, they could end up with $70 an acre in a price loss coverage payment in October of 21. So again, it's a long ways out. And it's not based on anything they planned. It is on their base acres. So it doesn't matter which crop they plant, it'll be reflected by base acres. So there is some help or some support in the farm program. So I just wanted to show how the carry had changed, how it had gotten real low in February and basically has doubled since then. So so people that have on-farm storage and maybe got some priced there's probably a decent opportunity as we get closer to harvest to roll that forward and capture the carry there. World production up quite a bit, 72 million metric ton. Most of that coming from the U.S. Increase. Go down. So again, yeah, production up. It said most of it coming from the United States, and use is up, so it's positive. But our ending stocks worldwide continues to grow. Just a quick look at soybeans then. Again, world increase big, United States a little over half of that in the increase. The rest coming really from probably Brazil and Argentina, South America influence on soybean production. Worldwide, that ending stocks is going down. So we are using a little more than what we're the production increase. So that's a good sign for soybeans and potential for price increase. So just, oh my, I'm struggling today, Heather. So just quick look at soybeans, where we end up, our stocks to use going down to a 9.4. That's pretty positive. And we could look for maybe some increase in soybeans. You know, it'll be interesting how it plays out. If that average market price ends up to be 8.20, there would be a small PLC price loss coverage payment. Now, most producers probably for soybeans at the time of sign up, the ag risk coverage or ARC County was probably the choice, or it was the major choice for most producers. And that benchmark price is right at $8.98. Projected insurance is at $9.17. Probably not going to see an ag risk coverage payment unless there's yield problems. So those payments could come about with that price if there are yield reductions in a county. So that we'll have to see where yield and that ends up as we go throughout the year. And always the sun will rise and things will look up. It will get better. There's contact information, you know, and the other thing we've got, these corn wise might not be good for the corn seller, but we also have a lot of livestock producers in the state. So some decent opportunities for them to lower cost of gain. That's what I have for today, Heather.
Okay, any questions for Jack?
I apologize for the big fingers and the slipping of jumping slides there. Hopefully nobody got too dizzy.
Okay.
I'll be on to if they got questions at the end. So either way.
Okay. I think with that, Jack, if you want to quit sharing, we'll move into Matt's presentation, and then Matt can share his, and we will move into the last presentation of the day. Matt, you want to go in? There you go.
Give me a second.
Yep.
So that didn't work. Hi, everybody. Matt Dearson. As you can tell, or perhaps can't tell, I'm working from home. So this is, it's still a little clumsy. I'm going to try this approach and share a screen here. Just a second. Heather, can you see the cattle market screen?
Yep. It looks good now.
All right, thank you. So as I mentioned, I am working from home, not working from the beautiful but currently empty Harding Hall on campus. We'll take a quick look at the cattle markets, and I'm trying to keep an eye on the clock as well. So if I do start running a little bit at all long, just flag me to stop. Big thing on the cattle, if we just run through the different classes of cattle, the first concern is slaughter cattle. We can see here, this is weekly federally inspected cattle slaughter. It's all classes. So this would be steers, heifers, cows, bulls, whatever. There was a little bit of, the thought was there's a little bit of pulling cattle ahead that happened back here in early April, or really before COVID became a huge problem for the packing industry. And then slaughter fell off dramatically. And the talk is that it bottomed out here a week or two ago. It's not back to normal, but it's a better sign than being continued super low levels. Slaughter, come on, mouse. Slaughter weights are what expected to weigh on the market a little bit. As cattle are held back in feedlots, they add additional pounds, and that just delays when you bring a large supply of beef to the market. There is a little bit of a difference when you look at the breakout in terms of steers and heifers. Those follow that same general chart. Beef cow slaughter has fallen below the 5-year average as well. So the beef cow side of things has been slowed up. Dairy is taking a little bit of a different, or shows a little bit different pattern. Given some of the pricing problems and consumption problems with the dairy side of things, are seeing continued slaughter of dairy cows. So a little bit of a difference when you look across classes. Made a big deal a couple of different times about the volatility in the market. This is actually just a screen or a slide shot from the last time I talked to the dialogue crowd back in mid-November. So at that time, the volatility across strike prices and months was very low. So this would have been the term structure at the time, and all the volatilities were in the low teens area for live cattle. That meant put option protection was very reasonable at the time. And then the whole COVID thing kind of came into play. So it just took a snapshot of the volatility at different points in time since this mid-November or mid-February snapshot. So on this chart, here's that same volatility across different contract expiration months. So had you been looking at coverage for August of 20, for example, that volatility was about 15%. Then in late March, early April, volatility went through the roof or skyrocketed. Volatility on the June contract at the time was near 55%, and on the August it was near low 40s. That meant that at the money option coverage became just $10, $12 for an at the money option, things of that nature. Tremendously expensive to lay off risk. Right now, here in mid-July, the volatility is not as high as it was, and it's come down, but it's still substantially higher than it was pre-COVID. So some of the worst has perhaps been factored in or figured out by the market. And you can see that the volatility does have a decline when you start to move from current year expirations, June, August, October, December into 2021. Still not back down to the levels pre-COVID, but it's saying that the layoff risk at those areas is not quite as expensive as in the nearby months. So it is something, an important factor to realize and take a look at. Just a couple things to highlight. I grabbed, yesterday I just grabbed a June contract. You can see on the screen there, this is just a screenshot from the Chicago Mercantile Exchange. The very intuitive, I'm being sarcastic, LEM 2020. So LE is the electronically traded live cattle futures contract, and M is the ticker symbol for the month of June. So that's just the June or the nearby contract at this time. I put some reminders on the right-hand side there that the live cattle contract is a deliverable contract. Very late in April, there were a couple of contracts where producers said they or tendered an offer to deliver, and then I lost track of what happened, but it is possible to deliver on a live cattle futures contract. Put a couple other notes there. The futures contracts for live cattle, they expire or mature on the last business day of the contract month. So June live cattle futures would expire the very last couple of days of June, but options would expire on the first Friday of contract month. So it does create, in these short run situations, a little bit of disparity with a deliverable contract when your option coverage is good through versus a futures contract. And the main reason to get those options out of the way on a deliverable is to avoid any conflict with the actual delivery process. As far as price outlook, big disparity between what the USDA said earlier this week. It basically has live cattle futures prices right around $100 for the foreseeable future. I overlaid that with the Livestock Marketing Information Center price projections. They have the same short run problems on fed cattle through the second quarter. Then they've got a little bit more upside built in, especially as you get to the end of 2020 and into 2021. So that would suggest, if you believe the WASDE, you'd want to be doing some pricing sooner rather than later. But if you follow the LMIC and see that we could have a resumption in beef demand, that would, or both beef supply being produced and beef demand, you could have a substantial increase in the price paid to farmers. So leaving some upside open, looking at put options yet, or things where there is some upside availability would be the strategies to look at for live cattle. Switching over to feeder cattle. A couple things. Earlier this week, I got an old price alert on my August contract that I had set back when, probably a month ago. So I got a strange email saying, hey, look at the cattle price again. So feeder cattle futures, the GF is the electronically traded feeder cattle, and Q, again, not intuitive, but that is the symbol for August. So this is the August feeder cattle contract. This is cash settled. Both futures and options on feeder cattle expire on the last Thursday of the contract month, unless it's a holiday. So that would just be the month of November that has that earlier contract expiration time. Big news, I think, in the feeder cattle that's still sort of weighing on things. If we look here, this is the cash trade. This is just the auction receipts, but this is all feeder cattle across the United States that the AMS reports. So I'd highlight right here in this area what happened in March of this year. Only 524,000 head of cattle went through the auction barns versus really you got 1 million head in typical Marches. So across both auctions, direct sales, and other outlets, my math says that that's a good 500,000 head that didn't get marketed at their normal time during March. Has been an uptick in volume through April, so it's still, maybe it's light. It certainly didn't alleviate cattle that weren't sold in March, feeder cattle that weren't sold in March. They didn't all move in April, but a more typical level moved during April. A couple of things I just wanted to highlight. There was a recent grazing feed report out of the AMS showing that really prices were under a little bit of pressure as we moved into 2020, and some regret as far as having paid as much as they had. You can see the URL and such for that report. It only comes out one day a year, so it's just a handy little report to take a look at. Spot market price for grazing, and it includes Western South Dakota. I'll leave you to search out those details. Hay stocks, a lot of talk about keeping cattle, retaining ownership, feeding them a little bit longer. What are you going to do with cows? The May hay stocks, actually good news if you want to find some for South Dakota. It's typically been about 1 million tons. This is over 2 million tons of carryover or May 1 hay stocks. So combination of small disappearance over the winter and good supply last year. So that's good news there. I also have a chart showing the change in the hay stocks from last year at this time. So South Dakota about 100% increase in stocks compared to a year ago. And for both of these, if we look out western part of the United States, there's been early indications of some drought concerns, at least out there. So South Dakota's probably okay, but not the United States as a whole. Hay acres as well. This would be from the prospective plantings numbers. South Dakota, a little bit of an uptick in hay numbers, pretty steady. If we look at the change relative to last year, Iowa and Kansas seeing a little bit of an increase in hay acres from last year, but out west, even though the stocks are okay, they're not having an increase in acres. So that could lead to some feed supply situations if drought conditions were to materialize. Last thing here we've got is the same look at the feeder cattle, same type of thing. This is from the CME's website. You may need to jump through some hoops to get to this, but it just shows the volatility level currently compared to a week earlier. So if we see this volatility, it's in the 20s right now, so it's not as high as it was. And the volatility really tapers off, and you're back down to 22% when you get out here to the January expiration. So I look at that for someone with calves. If you've got, you're looking at doing some protection on calves, going further out is probably okay. January and March would be futures prices representative of the expected value of a 5-6 weight calf that you'd be selling in the cash market this fall. So that volatility is not as bad, and that's where I would look to be doing some protecting of prices. As far as price projections, these come from the LMIC for both the 7 to 8 weights in the middle column and the 5 to 6 weights on the southern plains. So you need to add a $5 bill to these to translate them up to the north. But you can see that those prices are probably going to be optimistic relative to the ERS price projections, which don't come out or don't get refreshed until Monday. But I did want to show you those for perspective. And recently, the calf price in South Dakota is in that low 160 area for a 5 to 6 weight steer. And that fourth quarter price projection there is still holding at 160 to 165. Last thing, we've got just a commercial. If you want some more information on COVID-19, we do have a link here to the In the Cattle Markets feature that comes from the LMIC. I'm one of the contributors, and that's been the focus in recent weeks. You can get to that through the extension website, clicking on agribusiness and scrolling down a little bit. I also highlight this new content by our colleague Matt Elliott, just got posted or updated yesterday, giving a current look and a historic look at South Dakota grain basis. Here's my contact information. You can also reach me via mobile phone, area code 605-690-0440 if you've got questions, because guess what? I'm not in my office, and but the email works great, and that's what I've got. So I know we're pushed for time. Apologize for going over for a second or two there. Are there some short run questions? All right, I'm not hearing any. So
Hey, don't get away so fast. Sorry. And I'm going to put you on this spot. You think LMIC is way optimistic, or what are your thoughts there? Let me reword it. Is it often that you see that much of a spread between the two?
Oh, never. No.
Okay.
No.
Seriously?
Yeah.
Okay.
That's especially on the, I don't know what the ERS is going to have for feeder projections. I suspect they'll be down from last month. It's tremendous wide variability in where price projections are coming from right now. If you try to compare this to, say, the futures prices too, you know,
Yeah.
what day of the week are you comparing these on?
Yes.
So, you know, so take it all with a grain of salt. I think it's the silver lining is that at least fundamentally, there's some reason to have some or hold out some optimism for where prices could go once the economy, if and when the economy rebounds, or once things get back. The longer the slaughter delay happens, the greater the backlog of heavy cattle that need to be processed and pushed through, and that will weigh on. That will just sort of be a standard, classical weigh on the market for a while. But there's always an end to that too. That's what I see.
And I don't want to take too much time. Cow market, boy, they really just, I see they weren't selling, but they just hammered that so hard too that probably discouraged people from bringing them in.
And I hope that would be the case. And that's why I highlighted the difference between the beef and the dairy. You know, dairy, that's unfortunately probably some really hard decisions and liquidations and things of that nature that could be just nothing better to do with these cows. If I've got beef stock cows here, if you got some opens or something, I don't think you're going to be penalized much by utilizing some feed or grass that you maybe have for, say, opens that you might have been thinking of selling in the short run or something like that. So just a little more flexibility, I'd say, on the beef side to hold back those animals until things get figured out. Now, with hamburger prices the way they are, as soon as the processors have the ability to move more animals through, I think you'll see that demand pick up and prices improve substantially. But it needs to have that processing capacity back online. So it'll help the cows too.
Yeah. Well, if guys have cull bulls, they need to check with their local auction or market, because that is still very good, or it was. Which yeah, I thought there was quite a difference.
It comes down to some extent to who's still willing and able to process different types of animals. So I mean, the major packers are set up to handle standard or uniform size slaughter steer and heifers, and you know everything else just depends on who's still up and running.
Yeah. Well, we might have just got lucky with our small operation that we were there on a good day and they needed some coal bulls because they sold
The
good.
weekly and across the board, the prices, the range of prices observed on everything is just insanely wide. And I'd be aggressive in seeking out better prices or better price levels, and that would apply across the board, whether you're talking about setting a good price objective to get a put option on cattle at some level, or picking a price level to establish a price for new crop corn. Just be more aggressive in setting your bids to get prices enacted or transacted.
Thank you, Matt.
I'm not seeing any additional questions come in. If you do have some, please feel free to type them in the chat box yet. We'll get them answered. Otherwise, we are running over a little bit. My contact information is on the screen right now. If you have questions for future programs, topics, we'd love to hear from you about some ideas for what you would like to hear about. I'd also encourage you, if you want to follow me on my Facebook page, that's where you can get information on upcoming webinars, other meetings and programs that we're hosting within a lot of the econ side of the coin here within Extension. And obviously, if you have other questions that I can't directly answer because they're related to agronomy or livestock components, we will get you to the right person and help you find the answers that you need. So last thing, I guess, next session will be June 19th. If you want to go register for that, you can. It is live and available at this time on the extension.sd state webpage, and you go to the events tab and click that. You can register there for next month's program. So we'll get you a list of topics as soon as we can, and we will send out the recording as soon as we can. With that, I will say thank you very much for joining us today, and have a great month and week. So thanks for everybody participating.